It's time for WorthPoint Wealth Watch with Christopher Van Slyke, partner and founder of WorthPoint LLC. Tired of the same sales pitches disguised as financial advice? Christopher is a certified financial planner who will give you the real facts about investments, tax planning, estate planning, and have a little fun doing it. Now, here's Christopher.
Good afternoon, Austin, Texas. This is Christopher Van Slyke. I'm here with my associates, who I'd like to announce themselves now, but we are a wealth management firm with offices in San Diego and Austin, and we're going to be spending a little time with you each week on Sundays at 3:30 to talk about financial planning topics that hopefully you'll find interesting. Fellas, why don't you chime in and tell us who you are?
My name is Scott Obrien. I am a certified financial planner and one of the partners here at WorthPoint.
My name is Kermit Johns. I'm a wealth advisor here at WorthPoint in Austin.
And my name is Morgan Smith. I'm a certified financial planner and a partner at WorthPoint as well.
Morgan just moved here from San Diego. And why don't you give us a little bit of your first impressions about Austin, Morgan?
It's been a busy life, Christopher.
Moving cross country?
Yeah, moving cross country, selling a house, buying a house, finding a new home, having a new baby. So if you got any questions, I'm your answer man.
Pay attention, Austin. There are a lot of these Californians showing up here on the shores of Austin.
But I don't want to make Austin California, okay?
You don't. We just want to uplift it a little bit. So I just want to say before we get into this that we are big social media users. We would invite you to find WorthPoint on Facebook, LinkedIn, and Twitter by typing in the name WorthPoint. And WorthPoint has an E on the end of point. Let me just say that. You can also find us on the internet at worthpointradio.com. And if you're interested in a discovery meeting, a second opinion, or to register for one of our webinars or seminars, that's where you do it. So let me just wade right into today's topic, which is what we finance geeks call the efficient markets hypothesis. This was first coined by a guy named Gene Fama in the 60s. It just so happens that his firm is the largest investment firm in Austin. It's called Dimensional Funds. It's over at the corner of 360 and Bee Caves. And he sort of came up with this idea that the market itself, that is sort of the collective wisdom of all investors, was actually smarter than any one of us. And, considering that all those nice homes in the Hamptons and a lot of tall buildings in New York City are paid for by the idea that if you give your money to professionals or if you do your homework, you can beat the market, it was a pretty disturbing idea. So, we tend to believe that markets are pretty efficient, but what we want to talk about today is whether that's baloney or whether it's the truth. What do you gentlemen think?
It's not baloney, that's for sure. But I tell you what, before we move on, let's go ahead and all agree to call this mouthful efficient market hypotheses, EMH. Agreed?
Yeah, I like that.
Okay,
I
EMH.
second that, yeah.
You got that, radio audience? It's EMH.
Yeah, the very word hypothesis gives me fits.
So I like to give the analogy of Craigslist because, I just moved into a house. I'm trying to buy stuff for my baby and my new home and furniture and all this stuff. So we all know Craigslist. Here's the analogy that I give is that I can go out and let's say I'm looking for a coffee table.
Which you are.
Yeah, how much does a coffee table cost?
I don't know.
In Austin.
I bet you do.
I do. And guess what? I can find one for $50 cheaper up in Oklahoma City. So, the smart guy in me says, hey, look, I found this great coffee table for $50 or less.
But you got to go get it.
Exactly. That's the problem.
So after you subtract those costs,
fuel,
it's more expensive.
Fuel, getting up there.
Depreciation,
driver lodging,
time,
food, the whole 9 yards.
Accident risk.
So that's kind of the point behind our philosophy on EMH is there may be good deals out there, but after you add up all the costs, like going and driving to Oklahoma City to get your coffee table, it's not worth it. So that's an important thing to think about.
So what you're saying is transactions cost matter.
Big time.
There's a lot of really good ideas in finance, but after you get done subtracting the the tax cost and paying the professionals involved, maybe there's nothing left over for you.
That's a good story, and we're making light of it right now. But when it comes to your money, that's important to you and your family, and it's money you can't afford to lose. It's really important to think about these things. A lot of people think they want that guy who can predict the future and get them that good deal. And sometimes you think you're that guy or that woman who can go out and find a good deal. And you may find a good deal, but really the cost of getting that is oftentimes too high to really give you any benefit from it.
Well, we know that when you look at all investors, both professional and non-professional, and you compare their performance to the market itself, that most of them don't beat the market. So the test for this theory really is, okay, let's look around for evidence that somebody can do a better job of picking stocks than the market itself. And if there are people, well, I guess you could identify them and you'd see this consistent performance. Unfortunately, when you do that, most of them don't do it.
Well, and part of the thing is, you mentioned the guys at the Hamptons, and these guys in the Hamptons
love those guys.
Yeah, they're great guys, and the thing is, they're very smart and they're very competent. But there's so many of them that they're all competing at the same time, trying to find that same information, get that same edge. So when you get so many people that are working hard, getting paid well, and at the same goal, looking for the same goal, it's hard to find someone who's going to consistently outperform another guy.
You're absolutely right. It's the guy who says that he has a great idea about something and forgets that everybody else has the same idea at the same time. Because most of the time, all the time, it's out there in the media already.
Yeah, I mean, 20 years ago, there wasn't the internet, and the guys in New York they'd go out to dinner and have drinks after work, and they'd swap some stories. I heard this from somebody, I heard that from somebody, and they sort of had some quote unquote inside information. They could act upon it. But nowadays with the internet, it goes around, something happens in New Delhi, you have the earthquake in New Delhi, and 5 minutes later everyone in the world knows it happened.
Well, and that's a really good point, and it's a follow-on to this whole idea of Craigslist. So what have I found now? For example, Amazon.com is a great place to find stuff. Well, all of a sudden you start seeing in there, we'll beat anybody else's price, and you start doing research on other websites. Everyone's got about the same price. So it's all this information built into the marketplace. The best pricing out there that you can find with regard to merchandise is out there in the marketplace. I think that's the same idea.
I used to use this analogy. There are smart people that work in finance, right? I mean, Warren Buffett's a smart guy, and a lot of those people on Wall Street are smart guys. But I always think about fishing. If you take the greatest fisherman in the world and you send him to a lake with no fish in it, how many is he going to catch?
Yeah, that's right.
Zippo.
Yeah.
Right? And it's because there aren't any deals in the marketplace. The market's just too shrewd and efficient.
Well, there actually is a way to beat the market, isn't there, though? You could cheat.
Well, yeah, if you have inside information
Exactly.
That other people don't have, but that's by definition illegal.
And you go to jail.
And there are a bunch of firms on Wall Street, hedge funds, et cetera, that are sending their CEOs to jail. SAC Capital, that one just got in a ton of trouble, and you kind of see a stream of these things going down. So basically, you're right. You have to cheat and steal to beat the market, and then there's still no guarantee. It's not like there's evidence of anybody really having persistent outperformance.
Okay,
Yeah.
let me play devil advocate. What about Warren? Because I get this all the time. What about Warren Buffett? He's outperformed the market. And what about Peter Lynch in the 1980s when he was flying high at Magellan? How do you explain that?
Well, how you explain that? We've got a minute. So we'll talk statistics, and I won't get too into it, but there's the bell curve. And it just so happens that the tails are very fat, is what they call it in statistics. And basically, according to statistics, there should be a lot more Warren Buffetts just out of random chance. So, there's going to be Warren Buffetts out there, and guess what? There actually should be more.
And we're going to talk about after the break. We're going to take a little break here. But after this break, we're going to talk about some of the ways people try and beat the market. Some of the zany things we've seen over the years.
Always get what you want. You can't always get what you want. But if you try sometimes, well, you might find you get what you need. Yeah.
the latest on food, wine, and fun right here in Austin. Join me, John Demers, for Delicious Mischief. That's Saturday mornings at 10 on the all-new Talk 1370. It's radio with lots of good taste.
From food and wine, weekends were made for Talk 1370.
Welcome back, Austin, Texas. This is Christopher Van Slyke with Worth Point. I'm here with my associates, Morgan, Kermit, and Scott. We're all advisors with the firm, and today we're talking about efficient markets, or EMH. Does it pay to try and beat the market yourself or pay other people to do it for you? This segment's going to be about zany ways that we've seen people trying to beat the market. Now, I don't know if I'd call Warren Buffett zany, but I have seen some analysis of his performance and compared it to, because a lot of what explains Warren's performance is that he's what's called a value investor. So he does sort of he's always quoted as beating the market, but that's the S&P 500. That's sort of a U.S. broad market. But he specializes in a type of investing called value investing, where returns are higher in general.
Yeah, there's another nuance to that, and that's that he actually provides intellectual capital to his ventures. But
he's really a manager.
Yeah. So I think we should kind of go back to this idea that you're touching on.
He's also 83.
Yeah. And are you going to be able to take advantage of that?
Yeah. Even if he is good, I'm not sure I'd bet on that horse.
There's an opening there, isn't there?
Yeah, for Worth Point.
So I think this whole thing with we're talking about efficient markets and the hypotheses that was laid out by Eugene Fama in the 60s. And it's not something like the Earth
There's that word hypothesis.
Yeah, the EMH. Let's talk about EMH. All right. So it's not like the Earth is round. There's some people who say, God, we don't believe in this. Here's some problems with it. So let's talk about 3 problems, or actually 3 anomalies they call for EMH. 1, insider trading. We know insider trading can
lands you in jail.
Not
a good.
The other one is momentum effect. And
what's momentum?
Momentum is the idea that if, for example, if stock price is going up, it will continue to go up. There's a trend of that.
That doesn't sound very efficient.
Doesn't. And also there's another anomaly, which is stock returns around earning announcements. So what Eugene Fama, who started Dimensional Funds, explained this is that it's still very difficult to make money out of these apparent anomalies because the amount of trading you would need to do to exploit these effects would wipe out any gain. So
it's the driving to Oklahoma problem. Yeah. It's the same problem. Yeah, I hear. What else, Scott? Whatever crazy attempts have you seen to? What about hedge funds paying 5 and 50? Is that a good deal?
It's a great deal. Everyone should sign up for that.
So this is how hedge funds work. Give me your money, and I'm going to make a big bet with it. And if it works out, you give me half. And if it doesn't work out, that's on you.
Yeah. Plus, I get my management fee. Plus, you get a percentage of the return that you have to turn over to them as well. And so the return last year for the average hedge funds was 7.4% last year, and the S&P 500 went up
31%.
So, and it's the
how could that be? Why would you invest in something that had a track record like that?
And it's 5 years in a row that's happened. This isn't just last year. It's 5 years that they haven't beat the S&P 500, if you want to use that as a benchmark. So how they keep getting people to give them money, I don't know. I think they close down, and then they come up with another story again, and they go back and resell it.
Right, reopen under new management.
That's right.
Exactly.
Well, we could take a cue from Bernie Madoff.
We don't want to take cues from Bernie Madoff, do we?
His
negative cues.
His selling point was, well, maybe we'll let you into the clubhouse here, but just don't ask any questions. So
you're saying a lot of people buy hedge funds for the cachet?
Exactly.
Really?
It's that somebody's got that secret golden key.
It's like a Lamborghini?
Uh-huh.
Wow. I have heard that. I've heard that wealthy people stand around cocktail parties talking about how cool the hedge fund they got into.
That's very true. There's a bandwagon effect, I think, in getting, especially when people try to invest with Bernie Madoff. It was you were part of a family. You belonged to that country club. Mm-hmm. And as you remember, there were a number of celebrities who were part of the Bernie Madoff disaster. They knew one another. So I believe that there is a bandwagon effect there.
But wasn't Elliot Spitzer was the attorney general?
Oh, not Elliot Spitzer.
He was going.
That's the guy into the prostitutes.
But he was going after all the Wall Street firms for all the things they were doing wrong, and he was one of Madoff's victims. So here's a
personally, he had money invested.
That's what I read. I read that. So he was, and then of course it was all the
I'm starting to question Elliot's judgment.
Yeah, no.
Between the prostitutes and his investment acumen, that guy really... I'm glad that... Didn't he just run for another office in New York?
Attorney General or something like that?
He ran for mayor in New York.
No, he was Attorney General.
Yeah, mayor,
I think he ran for... Was it mayor or one of the boroughs?
No, he ran for mayor.
Oh, it was Anthony Weiner that ran for the job in the boroughs.
Nobody wanted him.
Yeah, nobody wanted either of those two guys, and thank goodness. It restored a lot of my confidence in New York. You used to live in New York, Kermit?
I did. I was born and raised in New York City.
Okay, so
now De Blasio, who's the new mayor, is in trouble for eating pizza with a fork. So you really can't win in New York, honestly.
Yeah, you guys have some nutty politics over there.
Market timing is the other thing that people do all the time that doesn't. It sounds great, but it doesn't work. But everyone thinks, I think Morgan said, that there's a secret sauce there. Someone's got to know something that somebody else doesn't know, and that they're going to exploit it somehow. And it's crazy to me, because if they was somebody who could do it consistently, they'd be the richest person on earth, and they wouldn't need your money. You wouldn't need to buy their newsletter, and you wouldn't have to invest with them, because they would just keep doubling their money.
So you got to kind of wonder, why does Goldman Sachs take your money and charge you a fee if they can really grow it that fast? Do you think they just take their own money and grow it?
Yeah, and as they say, there's no market timers on the Forbes 400 list. You'd think one of them would be there.
I think the guy at the top's in the computer business. Something like that. All right. So we're going to go to a break now, ladies and gentlemen. But after the break, we're going to talk about what actually does work in investing, since we've talked a bunch about what doesn't.
You can't always get what you want. You can't always get what you want. But if you try sometimes, well, you might find
an Austin native and top lender since 2001, John Schutze can help you quickly determine the best mortgage option to complement your long-term financial goals. Join John in House Talk Radio every Sunday from 5 to 6 p.m. here on Talk 1370. John's number one goal is to provide you with a smooth and predictable mortgage experience. So tune in right here on Talk 1370 every Sunday from 5 to 6 p.m. for John Schutze and House Talk Radio, providing you with a smooth and predictable mortgage experience. House Talk Radio every Sunday from 5 to 6 p.m. only on Talk 1370.
NMLS number 208548.
Good afternoon, Austin, Texas. This is the Worth Point Wealth Watch. I'm Christopher Van Slyke, sitting around with my associates, and we're talking about EMH, or the efficient markets theory, or the whole notion that anybody can even beat the market. And we've been having fun with it and poking holes in it. But I think that we should actually talk, it kind of makes you want to throw up your hands and buy index funds. Which isn't a bad idea for a lot of people. But there are some other things you can do. So let's talk in this segment. We've got about 9 minutes here. We're just going to talk about what does work in investing. What should you be focusing on as investors?
Yeah, so one of the things to think about in your mind when you're thinking about this is there is a difference between what's commonly referred to as passive investing versus an active manager. So an active manager is somebody who's really trying to pick a stock, predict the future, look at macroeconomic indices and things like that to say, hey, this is where you need to invest. And a good voice out there in finance has said, really the relevant question for investors isn't really are markets efficient, but it's are active managers able to persistently exploit anomalies after cost. So I think that's a good way to couch the discussion.
Okay. So I think we agree based on our earlier discussion. If you look at all the scientific literature, and you just compare people who are trying to beat the market to the market, they don't. So what does matter? What should I be focusing on? What about diversification? is how many things I own important?
Yeah, I think diversification is one of the key points because you just never know from year to year which segment of the market's going to outperform. And we recently sent out a email to our clients about all the sort of the bad news or the news that was in the market last year. And who would have thought, with all that bad news, debt ceiling problems, Detroit going bankrupt, still wars going on in Syria, that the market would go up 30%, and the U.S. market. But we just didn't know that was going to happen last year. And so, sure, you would have done better.
What about Greece? What if I had all my money in Greece?
Well, that's right. Yeah, and Greece actually went terrible the year before, and actually went up the year after because
what if I had it all in tech stocks?
Yeah, all in tech stocks in 1999 and 2000.
That wouldn't have been a good idea.
So by diversifying,
or bank stocks.
Yeah,
there's a
guy that says he says by diversifying you guarantee that you won't make a killing, but you also guarantee that you won't get killed. And so by diversifying, some years you say, I'm glad I did it, and some years say,
what do we mean by diversifying? Is that 10 companies? What's diversification?
Yeah, there's a school of thought on that. We prefer to have thousands of companies, and so that there's never one that's going to explode in our portfolios and really cause some damage.
Or even a country or a currency.
Yeah, that's right. Yeah.
What about cost? Do costs matter?
Yeah, most of the good economists and finance folks out there will say that, there's two real big factors that are going to negatively affect your performance, and that is human behavior and costs and fees. And it's a huge drag on wealth, especially when you compound these factors over years and decades.
What about taxes?
That's the number one drag. On this is I talked to clients. I said, it's really a return after taxes, is that's what you get to keep. So
Uncle Sam is your partner.
And a lot of active managers are their turnover is 100% a year, which means whatever you had in January.
One of my pet peeves is annuities, because people will buy a tax deferred annuity where you put your money in and you don't pay tax until you take the money out, but it's ordinary income. Which is taxed at double the rate of capital gains income. So I don't understand why they don't put their money into bread and butter mutual funds, which would be taxed at a long-term capital gains rate, which is half the income tax rate.
Yeah, and that's a good point. To give us a call and talk to us about if you've got a very large IRA, that's a tax monster waiting to happen. And very intelligent planning is doing Roth conversions or partial Roth conversions, so you don't have that big tax burden. So that's something to give us a call and talk to us about some advanced strategies in planning.
Plus, you mentioned annuities. One of the worst aspects of annuities is just the simple cost of them. You talked about the cost and the transaction fees. Sometimes you're paying as much as 3 or 4% that you never ever see inside an annuity, just to pay for factors and bells and whistles inside that annuity that you're never ever going to use.
Yeah, to me, you win on the tax argument alone on annuities, but if people want to get into the expenses, there are a lot of expenses involved.
And the one thing, I'm sorry, go ahead.
I was going to say it's sort of like Obamacare. You're going to be buying a lot of things you won't use. Exactly. So you might be a 17-year-old male, but you're going to buy maternity coverage, and sort of the same way with annuities. Not that I'm picking on Obamacare. I love it. I'm just saying.
I apologize. I stepped on your punchline.
Been saving that all day. So what else?
Well, allocation is the other side of not other side, but allocation we haven't talked about. And a lot of the studies show that that's 90% of the choice.
How you put the portfolio
together.
Yeah,
as you said, how do you cut that pie up is the major, no matter how you sort of invest in diversified after that, is how much are you going to put in U.S. stocks, how much are you going to put in real estate, how much are you going to put in emerging markets, and how much are you going to put in developed markets, and that's small
value.
Yeah, and
direct profitability.
And it sounds like it might be simple to do, but I mean, our investment committee, we look at all kinds of statistics and standard deviations, all kinds of stuff that most people don't want to hear about, probably, or don't.
Yeah, asset allocation really is more of an art than a science.
That's right. Yeah,
that's the thing. It's the most important thing you do. How you carve up your pie. At the end of the day, 20 years down the road, what's really going to matter is what your portfolio look like, what your expenses were, how you manage taxes. It isn't going to be whether you bought IBM or Dell, and it isn't going to be whether you jumped out before the crash in 08 and jumped back in 09 at exactly the moment, because you have to get that right twice.
Well, here's one of the most important things on how to do things right that most investors I talk to have no idea of. If you look at the compound average annual returns of the U.S. stock market between 1926 and 2008, you just have all the stocks in there in a bucket, and you've got new companies coming in. This is all the winners and all the losers. Guess what your compound annual return is going to be? 9.4%.
10% was going to be my guess.
So we'd all be happy with that. You'd be happy with that. Now, if you took out the top 25% performers every year, you've got a negative 1% return. So that's a key part of diversification. You have to have those winners in your portfolio. And most people think, well, God, I've got to just have the winners. Well, no. You
but you don't know what the next winner is going to be. That's the problem.
Exactly. So if you basically capture essentially the entire market, you've got all the important winners that are going to give you that 9.4% return. That is one of the significant keys of diversification.
What else? What else, Scott? What else is important?
Let me think. Well, you mentioned, I think we think investors should focus on what they can control or what we can control for them, and that's the cost, the tax minimization, diversification, allocation, and all the other stuff it's CNBC and stuff on the internet. It's interesting, but
what about Kramer though? It's a lot of fun.
He is fun, but he is what we call investment porn, right?
Oh,
you wanted me to say that today.
I really did. We're going to do a whole show on investment porn. Investment porn, ladies and gentlemen, is the prurient interest that we all take in Money Magazine and Kramer and all that stuff that really doesn't bear any fruit, but which we all have trouble resisting. Anyway, we're going to wind down the show today, folks. I want to remind you that you can find us at worthpoint.radio.com. You can find us on Facebook, Twitter, and LinkedIn. We'd love to hear from you there. Please give us your questions via those social media vehicles or email from the website, and we will read your questions on the show. Next week, we're going to have a heck of a topic. It is going to be how to find a financial advisor. What should you look for? Give us something, Morgan. Come on.
Just Worth Point. That's all you need to know.
Oh, it's obviously good looks and charm.
Right. No, there's some other things we're going to talk about next week. Goodbye, Austin. We'll see you.